Before you take any Forex Fundamental Analysis course, watch this. Because in the next 30 minutes, you and I are going to strip away the myths, the noise, and the endless confusion that surround what traders call fundamentals. By the end of this session, you'll understand not only what moves currencies, but why they move, and how you can read that motion like a professional. My name is Alex Rossi, lead AI instructor for the Forex Fundamental Analysis Masterclass at Traders MBA. And together, we're going to take a deep look inside the real engine of the global market. Every trader has that moment early on. The moment when they realize that charts alone can't explain what's happening. You're staring at a perfect setup. The indicators line up. Momentum looks right. And then, out of nowhere, the price moves the opposite way. The candles flicker red, the stop loss triggers, and you sit there thinking, what just happened? That confusion is the starting point of understanding, because it's the moment you begin to see that markets don't move because of drawings on a screen. They move because of data, decisions, and expectations. Behind every tick of price, there's an underlying reason, a flow of money responding to the real world. Fundamental analysis is simply the discipline of understanding that cause and effect. It's not about predicting headlines or memorizing economic jargon. It's about logic. It's about seeing the relationship between growth, inflation, employment, interest rates, and confidence, the variables that shape monetary policy, and by extension, every currency on Earth. Once you see that relationship, you stop reacting and start anticipating. You move from being a follower of price to an interpreter of value. Think of the Forex market as a living network that connects every economy, every government, and every decision maker in the world. When something changes in one part of that network, when inflation climbs in the United States, or GDP contracts in Europe, or the Bank of Japan hints at tightening, that change ripples instantly through the system. Traders who understand fundamentals can see the wave forming before it reaches the shore. They're not surprised when a currency strengthens or weakens, because they understand the pressure building beneath the surface. So what really gives a currency its strength? At its heart, value is built on trust. Trust that a nation will manage its economy responsibly, that its central bank will protect purchasing power, that investors' capital will be safe. When that trust grows, demand for the currency increases. When it fades, capital leaves. Fundamental analysis is therefore the art of reading trust, of seeing where it's building, where it's cracking, and how it's likely to shift next. Let's make this tangible. Imagine two economies. One is growing steadily, wages are rising, inflation is moderate, and the central bank is credible. The other is slowing, prices are unstable, and policy is uncertain. Global investors don't need a pep talk to decide which one they prefer. They move their money toward the stable, growing economy. To buy its assets, they must buy its currency, and that demand drives appreciation. Multiply that process by every fund, corporation, and central bank in the world, and you begin to see what really moves exchange rates. It isn't chance, it's capital following confidence. The tragedy is that most retail traders never see this. They look only at what's already happened instead of asking why. They chase momentum without understanding its fuel. They think the market is random because they're watching the surface of the water instead of the current beneath it. But once you start connecting macro data to market moves, once you can link inflation prints to policy expectations, employment data to rate decisions, and rate decisions to currency strength, everything starts to make sense. Patterns stop feeling mysterious. You can see the chain of reasoning that drives price. At the core of that chain lie three fundamental forces: economic growth, inflation, and interest rates. Together they define the rhythm of every market on Earth. Growth tells you how much activity there is in an economy. Inflation tells you how hot that activity is running, and interest rates are the instrument used to manage it. When growth is strong and inflation is under control, confidence rises, policy stabilizes, and the currency tends to strengthen. When growth falters or prices spiral, policy shifts and value adjusts. Understanding this triad is the key to understanding everything else. Economic growth is the engine of strength. It's measured by gross domestic product, the sum of everything a nation produces. When GDP expands, jobs are created, profits rise, and tax revenues increase. Investors notice that momentum and want exposure. They buy shares, bonds, and businesses within that economy, and to do so they must buy its currency. That steady flow of foreign investment lifts the exchange rate. But not all growth is created equal. Growth driven by productivity and innovation builds long-term resilience. Growth fueled by cheap credit or unsustainable debt often ends in correction. The professional analyst learns to tell the difference. Inflation is the temperature gauge. Too cold and an economy stagnates. Too hot and it overheats. Rising inflation erodes purchasing power and forces central banks to respond by raising interest rates. Falling inflation signals weakness and prompts easing. These cycles of tightening and loosening are what give Forex its rhythm. A single sentence in a central bank statement can shift billions because traders are constantly recalculating where that cycle stands. Is the next move a hike or a cut? Are policymakers more worried about inflation or growth? Those questions shape every chart you'll ever see. Interest rates are where all these forces converge. They represent the price of money itself. For a saver, they're the reward. For a borrower, they're the cost. For a trader, they're the heartbeat of expectation. When a country's interest rates rise relative to its peers, its currency usually strengthens because investors chase yield. When they fall, capital tends to flow elsewhere. Yet the real movement happens not when rates change, but when the market expects them to change. Professionals trade those expectations, not the news, but the logic behind it. That's why the best analysts behave almost like detectives. They collect clues, employment numbers hinting at wage pressure, manufacturing data pointing to cooling demand, inflation releases suggesting policy shifts ahead. Each clue builds a picture of what the central bank will do next. Because currencies move on anticipation, the earlier you can interpret that picture, the further ahead of the curve you are. Most retail traders, however, don't think in that sequence. They wait for the official announcement and then react. By that point, the move has already happened. The institutions were positioned days or weeks earlier because they understood how the data would influence policy. That's what separates professional logic from retail emotion. Fundamentals aren't about guessing tomorrow's headline. They're about reading today's evidence. And that evidence is everywhere, in labour reports, in inflation readings, in consumer spending, in trade balances, and in fiscal budgets. Every data set tells a small part of the story. On its own, it may seem irrelevant, but together they form a living map of the economy. When you learn to read that map, you begin to see where policy is heading long before the market does. Let's step into the mindset of a central banker for a moment, because that's what a true fundamental analyst does. Picture the Monetary Policy Committee sitting around a table at the Bank of England. They're looking at inflation slightly above target, unemployment near historic lows, and wages rising faster than productivity. What do they conclude? That demand is running ahead of supply and price pressure is building. The logical response is to raise interest rates to cool it. A trader who understands that reasoning doesn't need to wait for the decision day. They can anticipate the tone of the next statement, the bias of the votes, the likely market reaction. That is how professionals trade policy. Now contrast that with a different scene, perhaps in Tokyo, where growth has slowed and inflation is barely above zero. The Bank of Japan sees weak demand and aging demographics. It knows raising rates would choke what little momentum remains. So it keeps policy ultra-loose, anchoring yields near zero. That decision makes the yen cheap to borrow, and global investors use it as a funding currency to buy higher-yielding assets abroad. This is the logic behind the carry trade, the practice of borrowing in a low-rate currency to invest in a high-rate one. Entire global trends are built on these policy differences. Understanding these interactions means you can interpret the market's rhythm instead of fighting it. You stop being surprised by volatility because you see what's driving it. When the Federal Reserve hints at tightening, you already know which currencies are likely to strengthen. When the European Central Bank sounds cautious, you can anticipate which pairs will fade. You start trading the reasoning, not the reaction. But fundamentals aren't just about numbers. They're about human behavior. They're about how investors respond to fear, greed, and uncertainty. Even central bankers, with all their models, are ultimately human beings interpreting imperfect data. The market reacts not just to what they say, but to how confidently they say it. A single change in tone, from persistent inflation to moderating inflation, can shift sentiment overnight. Learning to hear that tone is part of fundamental mastery. The deeper you go, the more you realize that everything in Forex is connected. Inflation to policy, policy to yield, yield to capital flows to price. Fundamentals give you the blueprint of that connection. Without it, you're guessing. With it, you're reasoning, and reasoning lasts. When you begin to think in this structured way, trading transforms from a guessing game into an exercise in logic. You no longer feel lost when markets move against you, because you understand the reasoning behind the move. You can look at a chart and know that what you're seeing isn't just volatility. It's a reflection of decisions being made by policymakers, institutions, and investors all over the world. That knowledge gives you something most traders never have: perspective. It turns anxiety into curiosity. Instead of asking, "Why did the market do that?" you find yourself asking, "What data caused this, and what will it lead to next?" That's the mindset of a professional analyst. Let's explore how this plays out in real time. Imagine it's the first Friday of the month, non-farm payrolls day in the United States. The data comes out stronger than expected. 200,000 jobs added instead of 150,000. Instantly, the dollar spikes. Why? Because markets interpret strong job growth as a sign that the economy can handle higher interest rates. Bond yields tick up, futures reprice, and the dollar strengthens. But here's where the professional perspective kicks in. A skilled analyst doesn't just look at the headline. They check the details, the wage growth, the participation rate, the revisions to previous months. If wage growth is slowing even as jobs rise, that suggests inflation pressure might actually be easing. The initial rally could fade. A few hours later, as traders digest that nuance, the dollar indeed pulls back. The professional wasn't surprised. They saw the deeper message hidden in the data. That's what separates knowledge from noise. The market overreacts to the surface. Professionals interpret the substance. And that substance always ties back to the same questions. What does this mean for inflation? What does it mean for growth? And what will the central bank do next? Now let's step back from the short term and think in cycles, because economies, like markets, move in rhythms. Periods of expansion give way to slowdown to contraction, contraction to recovery. Central banks tighten, pause, then ease. Traders who can identify where we are in that cycle have an extraordinary advantage. They can align their positions with the turning of policy rather than chasing it after the fact. When inflation has peaked and central banks begin to hint at cuts, Currencies that were strong may start to weaken. When growth rebounds and policymakers turn hawkish again, those same currencies regain strength. It's all about reading the rotation. One of the most valuable skills you can develop is learning to map those cycles across countries. Rarely are all economies in sync. While one region is tightening, another might be easing. Those divergences create opportunities. Think of the Federal Reserve raising rates while the European Central Bank holds steady. That difference widens the yield gap between the dollar and the euro, attracting capital to the United States and pushing euro-US dollar lower. Later, when the Fed pauses and the European Central Bank catches up, the trend reverses. Every major multi-year currency move in history has been built on those relative differences, not on randomness, but on rhythm. And here's the beautiful part. These cycles repeat. They don't repeat perfectly, but they rhyme. The late 1970s taught central banks the cost of ignoring inflation. The 90s showed the benefits of credible policy frameworks. The global financial crisis of 2008 reminded the world how quickly confidence can evaporate. The pandemic of 2020 demonstrated how fiscal and monetary coordination can ignite demand and eventually inflation. Each era reinforces the same truth. Fundamentals may evolve, but they never disappear. They are the language of markets, the grammar behind every price move. Now, when I say language, I mean it literally. Every economic report is like a sentence, every data point a word, and every policy meeting a punctuation mark. Most traders read fragments, a headline here, a rumour there. But fundamental analysts read the whole paragraph. They look for context, tone, and continuity. They understand that the Bank of England raising rates by a quarter point means one thing if inflation is rising, and something completely different if inflation is already falling. Meaning is not in the action alone. It's in the circumstances surrounding it. That depth of understanding allows you to trade with patience. You stop feeling the need to jump into every move. You start thinking like an investor, not a speculator. You realize that the goal isn't to predict the next tick, but to understand the next trend. And trends in Forex are born from fundamentals, from real changes in money, credit, and confidence. Technicals may show you the door. Fundamentals tell you which way it opens. Let's ground this in a practical example. Take the British pound. After the Brexit referendum, sterling collapsed, not because of any single piece of data, but because the world's perception of the UK's economic stability changed overnight. Investors feared reduced trade, weaker growth, and political uncertainty. Capital outflows increased, and the currency repriced to reflect that new reality. For months afterward, every speech, every negotiation, every piece of data was filtered through that lens of uncertainty. When clarity began to return years later, confidence slowly rebuilt, and the pound recovered. That entire episode was a lesson in how sentiment, policy, and fundamentals interact. Charts captured the outcome. Fundamentals told the story. Another example, the US dollar during the post-pandemic inflation surge. As consumer prices in America accelerated, the Federal Reserve turned increasingly hawkish. Markets began pricing in a series of rate hikes long before they were implemented. Yields rose, global capital flowed into US assets, and the dollar soared. Traders who understood the relationship between inflation and interest rates were already positioned. Those who ignored it watched in disbelief as charts broke through every supposed resistance. Again, not magic, just logic. Now, why does this matter so much for you as a trader? Because every profitable decision in Forex is, at its heart, a judgment about the future, a bet on which economy will outperform, which central bank will act, which policy will prevail. To make those judgments intelligently, you need structure. You need a framework that connects data to decisions. Without that, you're just guessing. With it, you can form a coherent view, test it against new evidence, and adapt as reality unfolds. That framework is exactly what professional education provides. And that brings us to the bigger picture, the difference between learning fundamentals piecemeal and mastering them systematically. Watching headlines or following influencers will give you fragments, but a structured program teaches you how the pieces fit together. It trains your mind to think like a macro strategist, not a retail trader chasing noise. Inside the Forex Fundamental Analysis Masterclass, we build that discipline from the ground up, starting with how to interpret data, how to analyze central bank policy, and how to connect all of it to currency behavior. It's not about memorizing theory. It's about developing intuition through logic. When you understand fundamentals properly, you start noticing patterns everywhere. A rise in commodity prices tells you about inflation risks. A change in unemployment hints at wage dynamics. A fiscal stimulus package suggests stronger demand ahead. Each clue feeds into your broader map of the market. The joy of this approach is that it turns complexity into clarity. The world stops feeling chaotic and starts feeling comprehensible. And let me tell you something about professional traders, the ones who last decades, not months. They don't rely on luck. They rely on process. They wake up each morning and ask the same set of questions. What's happening in growth? What's happening in inflation? What's the central bank likely to do next? Has the market priced it in? That habit, repeated consistently, becomes second nature. It's the difference between surviving and excelling. At this stage, you might be thinking, Alex, this all sounds rational, but markets don't always behave rationally. And you'd be right. They don't. At least not in the short term. Markets are emotional because people are emotional. Fear and greed drive overshooting in both directions. But fundamentals act as gravity. They don't control every bounce, yet they always pull prices back toward reality. When you trade with a fundamental foundation, you can navigate volatility with composure because you know where that gravity lies. You know which moves are noise and which are signal. Think about times of crisis, the financial crash of 2008, the pandemic shock of 2020, the inflation wave of 2022. Each began with panic, dislocation, and uncertainty. Yet in every case, fundamentals eventually reasserted themselves. Stimulus revived growth, inflation forced tightening, tightening restored stability. The cycle repeated because the underlying mechanics of economics never change. If you understand those mechanics, you don't fear crises, you prepare for them. You see them not as threats, but as transitions, moments when opportunity hides inside uncertainty. And that is the mindset I want for you. A trader who thinks like an analyst, who sees through the noise, who trades from logic, not emotion. Someone who recognizes that the Forex market isn't a casino, but a reflection of global capital-seeking balance. Once you see it that way, you'll never unsee it. Now, if you're serious about mastering this skill, about learning to interpret data the way institutions do, about understanding how central banks think and why currencies move, then the next logical step is structured education. You'll find the link to join the Forex Fundamental Analysis Masterclass right below this video in the description and pinned comment. In that program, I take you through the complete journey: inflation, GDP, employment, interest rates, fiscal policy, central bank cycles, sentiment, and real-world application. It's the professional foundation that every trader deserves. Because here's the truth, you can't control the market, but you can control your understanding of it. You can choose to stop guessing and start reasoning. You can decide that your trades will be based on logic, not luck. That's what professional development is all about. Replacing confusion with clarity, replacing impulse with insight. So before you take any Forex Fundamental Analysis course, watch this. Think about what we've discussed and then take action on it. Don't let the market remain a mystery. Learn how it works. Learn why it moves. Learn how to read it like a language. Once you do, you'll never trade the same way again. If you found this session valuable, don't forget to like, share, and subscribe. It helps more traders discover this channel and learn to trade the right way. And when you're ready to go deeper, click the link below and I'll see you inside the Forex Fundamental Analysis Masterclass. Until then, trade with logic, stay curious, and never stop learning. Because understanding is the ultimate edge.